we got managing current assets, which is an integral part of working capital management. We got working capital terminology. Under working capital analysis, we're going to learn that, right, working capital equals current assets minus current liabilities. And right, current ratio. So that's the ratio of like current assets to current liabilities. Now we have here a few categories of highlight working capital management. Now it could be highlight aggressive. So an aggressive working capital management policy is to have underlined current assets less than current liabilities. And generally that happens if you finance current assets with current liabilities, such that the current ratio that's low. So put a downward arrow there. Next, highlight conservative. So a conservative policy holds that underlying current assets, they should be greater than current liabilities. And one of the ways of doing this is by finance current assets with non-current liabilities, such that the current ratio that goes up. Or generally you would want to have highlight moderate or matching policy for working capital. So that's a policy which seeks underlying balance between current assets and current liabilities. Under working capital management, we're going to look at managing cash. We're going to look at management of marketable securities, which could be cash equivalents if the original time to maturity from the purchase date is 90 days or less. Then we'll talk about receivables management and inventory management. So let's first start with cash management. So we're looking at cash in hand as well as cash at bank. Now, managing cash is very important for any entity because an entity needs cash for a variety of purposes. So you need cash for number one, operations. So an entity would need cash to pay its vendors, to pay salaries to employees, to pay its utility bills. Basically, you need cash if you want to be running your operations. Now, at times, entities also have compensating balance arrangements with banks. So that's basically the minimum balance that an entity is required to maintain with the bank. If they don't maintain it, the banks would penalize them. So this would be compensating balances. Now, often you also want to have cash surpluses with you to take advantage of cash discounts offered by your vendors. So let's look at cash discounts. So let's say one of your vendors has offered you credit terms of 210 net 30. Now this means that the credit he has offered you is 30 days, but you can avail of a 2% cash discount if you make the payments within 10 days. So if you've managed your cash well, if you've got cash on you, you could make the payment 20 days early. So this is 20 days early. Take advantage of the 2% cash discount. Then entities also may need to have cash to take advantage of special business opportunities that may come their way. You can call it speculative balances. Or they might want to have cash to take care of certain emergencies, precautionary balance. So these are all the reasons why an entity may need cash. Now, an important component of cash management is float. So let us say you've issued a check to your vendor. You've mailed it to him. He gets the mail on day 3. He deposits it in his bank on day 4, and it gets cleared with your bank on day 5. So now what you could say is the float on your payment is 5 days. So your check was floating for 5 days before it got converted to cash. Now, similarly, let's say you've received a check from your customer. Your customer mailed a check on day 1. You received the check on day 2. You ran to the bank, deposited it on day 2 itself, and it got cleared on day 3. So now your float on this receipt from your customer is 3 days. Because the customer's check was floating for 3 days before it got cleared. Now, as part of cash management, the strategy is to try to maximize float on payments which you're making to your vendors and minimize float on receipts from customers. So a few strategies here could be, let's say, having a zero balance account. So this is an account, let's say, with a regional bank with zero balance requirements. So what happens is, in the morning, your vendors present checks to the regional bank. Now there's no balance in the bank. So what the bank does is immediately notifies you as to the amount of cash required to cover all these checks from vendors. You quickly transfer the cash and the checks presented are cleared. So there's no idle cash lying in this regional bank account. So that could be a good cash management strategy. Now, companies may want to have a lockbox system. Now, think about the way it happens. So customers, they send you the checks. Then you rush to the bank to deposit the check in the bank. How about the customers send the payments directly to the bank? So that is basically a lockbox system. So in this system, customers send payment to a post office box or a lockbox which is maintained by the bank. Now the advantage naturally here is quick processing. So earlier you received the checks, rushed the bank, deposited it. Now the bank is directly getting the check. And a second advantage here is it increases internal controls over cash receipts, as the firm personnel do not have access to the cash anymore. They can't steal it. So for lockbox system, let's look at a quick example on your book and understand, is it advantageous to have the system or maybe not? So we are looking at this example which says, if average daily cash receipts are $500,000, so this firm is receiving cash daily $500,000. It's got short-term interest cost of 4%, and it says a bank lockbox system would reduce its float by 2 days. Now, banks, they do nothing for free. So they're going to charge $36,000 per year here, and the firm would save $10,000 of internal processing costs. So now the firm would have to pay to the bank $36,000. But now because the bank is doing the processing of cash receipts, the firm would save $10,000 on its internal processing costs. So now the question is, should they go for this lockbox system or not? So let's do the calculations. So we are looking at daily receipts of $500,000. And we are saying that the float is going to be reduced by 2 days. So what you could say is, at any point now, the firm would have excess cash of $1 million, because $500,000, which now they're going to receive on day 1, they would have received on day 3. Now they're going to receive on day 2, they would have received on day 4. So day 1, day 2, 500 plus 500 million dollars, that's always surplus for them. Now they're saying the short-term interest rate is 4%. So the savings here is $5 million into 2 days into 4%. So that's the interest savings here. So you could say $1 million into 4% gives you $40,000. Now, what's the cost of this logbox system? The bank, they are charging handsome $36,000 for this facility. But that's not all. We are saving our own $10,000, which we don't have to incur anymore for our internal processing costs. So actually, our net increase in cost is only $26,000. So savings is $40,000, cost $26,000. Should we go for it? Of course, yes. We are saving more than what we are losing. So that is basically how you calculate, and you look at whether you want to have a logbox system. So generally, if you have a pretty wide consumer base, it might actually be very advantageous to have this system. Let's talk about a cable company which has got consumers across the country. So they might want to have a lot of logboxes with banks so that they can minimize float on receipts. Now, you could have other strategies for float. Let's say you could go for concentration banking. What you do here is you ask your customers to pay local branches instead of sending the checks to a regional or a national branch. So that would minimize float on payments. Sorry, on cash receipts. You could go for electronic fund transfer. So you could ask your customers to transfer the funds electronically so that it happens in a flash of a second. So electronic fund transfer, it ensures faster processing. So guys, with electronic fund transfers, this concept of float, this has actually become obsolete as all the fund transfers happen within seconds. We got cash management. And the strategy here is to highlight maximize float on payments and minimize float on receipts. Right there, float equals recorded on books but not received or paid by bank. And a very interesting strategy that we have here is put a box around logbox system. Highlight customers send payments directly to the bank to speed up deposits. Now this highlight increases internal control over cash. Naturally, it provides for more timely deposit of receipts, and highlight cost effective if interest savings is greater than the net increase in the cost of cash receipt processing. Now let's talk about marketable securities management. Now, as I told you, marketable securities, they could be cash equivalents if the original time to maturity at purchase is 90 days or less. If it's more than that, then it becomes short-term investments. Now, firms hold marketable securities for the same reason they hold cash. Now, such marketable securities, they can very easily be converted to cash. And the advantage over cash is that they provide an investment return. Now, you've got two very important considerations for marketable securities. Number one, liquidity. So you want the securities to be readily convertible to cash. And number two is risk. You want them to be safe. You don't want them to lose value. So you're looking at liquidity and risk. So often firms want to invest in federal treasury securities, which are regarded as the safest in the world. So you could invest in treasury bills. So these are treasury securities with maturity of 1 year or less. So you could look at, let's say, 91-day T-bills or 182-day T-bills. You could also look at treasury notes. So treasury bills, that's 1 year or less. This is 1 to 10 years. So that's treasury notes. If you have treasury bonds, that's more than 10 years. So treasury notes, you could look at a short term or intermediate term investment. Or you could buy treasury notes from the market when the remaining time to maturity is less than 1 year. So that's treasury bills, treasury notes, treasury bonds. These are all federal securities and safest. Now, the Fed also has an innovative security called TIPS. So that is Treasury inflation protected securities. Now, in case of TIPS, the interest rate is fixed, but the principal is adjusted semi-annually for inflation. So basically, these securities provide an inflation adjusted real rate of return. Now, you could also want to invest in federal agency securities. So let's say we're looking at the Federal Home Loans Bank. Now, these securities are not as safe as the federal securities, but they're safe enough and they trade pretty actively, so they provide you enough liquidity. And the good news is they would offer you slightly higher return than the federal securities. So slight increase in risk and naturally a slight increase in returns also. Then we could also look at certificates of deposits or CDs with commercial banks. So these are savings deposit at financial institution. Now, good news is the investment yields, they are higher than the government yields. But the bad news, they are not as safe. So if the commercial bank, it goes bust, you lose this money. But the safeguard here is these certificates of deposits issued by banks, they are insured by FDIC or the Federal Deposit Insurance Corporation up to a limit of $250,000. So if you have certificates of deposits of $250,000 with a bank and the bank goes bust, the Fed, they're going to insure you, they're going to reimburse you your money. Now, as part of marketable securities management, you might also want to invest in commercial paper. So these are basically issued by corporations. Now, commercial papers, they are usually not backed by any collateral. So generally you could say these commercial papers are issued by corporations which have high quality debt ratings. So you could look at a corporation like Walmart issuing a commercial paper. Now usually these commercial papers have up to 9 months maturity. So the rates offered on commercial paper are naturally higher than all this, and the risk is also higher. If the corporation goes bust, you lose the money here. Now, usually this commercial paper, they are held to maturity as there is no active secondary market for these securities. Now, for the corporation issuing out commercial paper, the good news is that commercial paper, it does not need to be registered with the SEC as long as the maturity is less than 9 months. So less cost of issuing these commercial paper. Then you could also look at bankers' acceptance. So basically this is a draft drawn on a bank but payable at a specific future date, not on demand. So this one is accepted and guaranteed by the bank. So it's generally drawn on a bank deposit. So these bankers' acceptances are generated by corporations to pay for goods, let's say in international trade. Now these may trade in the secondary market prior to the due date for payment at a discount. So we've looked at a lot of securities, a lot of options that you have for marketable securities management. We said certificates of deposits, these are with banks. Now you could also have euro-dollar certificates of deposits with foreign banks. So this was with US banks. Here we're looking at foreign banks. Now, note that these foreign banks, they are not under the jurisdiction of the US Federal Reserve and naturally are subject to much lesser legislation. So these deposits would generally yield higher returns than the certificates of deposits that you have out here. Now note, euro dollar certificates of deposit are denominated in US dollars only. Don't get confused with this term euro dollar. The term euro stands for foreign banks. Generally we're looking at European banks. You could also have Asian banks, let's say Japanese banks or Chinese banks, that's just fine. So euro dollar certificate of deposit means deposit with a foreign bank. It's still denominated in US dollars only. Then as part of short-term fund management, you could also invest in money market funds. So money market funds are mutual funds which invest on your behalf in these treasury securities, in the certificates of deposits and commercial paper. So on your behalf, they're going to invest in a mix of all the securities for the risk return trade-off. So you have these acting as mutual funds. So generally a money market mutual fund would have a net asset value of $1. And they don't give you a lot of return, but naturally they have liquidity and it's low risk. They would give you some returns in the short term. Now, if the money market mutual fund, if the NAV goes below $1, that's when you lose your money. So it's said that the mutual fund has broken the buck. Now, this generally never happened until the 2008 financial crisis. So Lehman went bankrupt and money market mutual funds, they lost value even below $1. So that created havoc in the market. So people started withdrawing their money from the money market mutual funds, creating a liquidity crisis. So that's when the Fed, they intervened and they started a new system. They said, if the money market mutual funds is paying us a certain fee, we're going to insure the investors. So if the NAV goes below $1, if these funds lose money, the Fed is going to insure the investors. So all that's story during the financial crisis. So that was money market mutual funds. You could also invest in money market accounts. So money market accounts, these are basically similar to savings account that you have with banks and financial institutions, where the banks or the financial institution invests on your behalf on these short-term marketable securities. Now the good news here is money market accounts are also FDIC insured up to $250,000, like this certificates of deposits. So these are also insured by the FDIC. Remember, this is all up to $250,000. Okay, so these are a lot of options that I've given you for short-term investments in marketable securities. Now, often you will also want to invest in debt securities or equity securities. Now, if you look at debt securities versus all this, bonds, it might offer you slightly higher returns, but then you also have higher risk. Equity securities, they could offer you even higher return, but naturally there's even higher risk. So guys, marketable securities management, you got to make sure that you look at the risk return trade-off. We're looking at marketable securities management. On top of this page, right, cash plus marketable securities. They're very liquid. So, right, risk is low, but at the same time, right, return is also low. Whereas when we're looking at, right, long-term investments, we're looking at, right, high risk and higher return. Now, when we're doing marketable securities management, our focus is highlight liquidity or marketability and risk or safety of the securities. Now, the available investments here are, right, treasury bills, highlight original maturity under 1 year, highlight treasury notes and highlight original maturity between 1 to 10 years. Highlight treasury bonds, highlight original maturity over 10 years. And then highlight treasury inflation protected securities, TIPS, and underline principal adjusted semi-annually for inflation. Now we got a bracket there on the left, right, US government, within bracket Federal Reserve. Next, highlight certificates of deposit, CD. On the left, right, banks. And the good news about these, right, FDIC insured. Next, highlight commercial paper. And this is issued by, right, corporations or, right, corp. Next, highlight Eurodollar certificate of deposit. And these are issued by, right, foreign banks. Next, highlight money market fund. And on the left, right, mutual fund. So these are shares in a mutual fund that invest in instruments with an average maturity date under 60 days. And these funds generally maintain a stable value for investors. So after the financial crisis, the federal government, they stepped in and they could insure the money market fund if the money market fund pays certain amount of fees to them. Then we have highlight money market accounts. These are maintained by, right, banks. And the good news here is, right, FDIC insured. Now we look at receivables management or management of these accounts receivable. So let's look at it here. Now we already talked about the accounts receivable turnover ratio. So that's the number of times an entity turns over its accounts receivable during the year. And we know a turnover ratio means turn it over. So on the denominator here, you're going to have accounts receivable. And we look at average accounts receivable. Beginning accounts receivable plus ending divided by 2. On the numerator, accounts receivable, that's related to credit sales. So on the numerator, you're going to have net credit sales. So basically on this accounts receivable turnover ratio, you're looking at sales by accounts receivable. So let's say if sales is $900,000 during the year and you got average accounts receivable of $150,000, the accounts receivable turnover ratio, how many times did you turn over this accounts receivable of $150,000? 6 times. Now, you also looking at the number of days in accounts receivable, the number of days credit that's been offered to your debtors, to your receivables. So, number of days in accounts receivable. So, that is basically 360, or generally if nothing is mentioned, use 365. I'm using 360 for easy calculations here. So, that's 360 divided by accounts receivable turnover ratio. So basically, in this case, what we could say is the number of days in average accounts receivable is 360 divided by 6, that's 60 days. So the receivables have been paying their dues in 60 days on an average, which means that the entity turned over its accounts receivable 6 times during the year because they paid in 2 months. So that means we could turn them over 6 times during the year. Now, number of days in average accounts receivable, you could also calculate it by looking at the average accounts receivable divided by the net credit sales per day, or let me just put it as net credit sales by 360. Yes. So if you use this formula and put it here, 360 divided by accounts receivable turnover. So that's 360 divided by net credit sales by average accounts receivable. And do it mathematically, you would get to this formula. So in this example, what's the average accounts receivable? The average accounts receivable, that's $150,000. How much is net credit sales per day? Net credit sales for the entire year is $900,000. So let's say a year in this case is assumed to be 360 days. So every day sales have been $2,500. So naturally that again calculates to 60 days, same result. Now as part of receivables management, our focus here is to minimize the number of days that you have in accounts receivable. Basically, this would help you minimize the cash conversion cycle. So focus here is minimize this. So we're looking at the credit period, the time allowed to the customers, to the debtors to be paying back their dues. So that's the credit period. So you might want to have a tight credit period as long as it does not affect your sales. You might even want to offer cash discounts to your customers. So we looked at a cash discount here. Let's say you've offered a cash discount of 210 net 30. That means the credit term, this one is 30 days. But if they pay within 10 days, they have a discount of 2%. Then before selling goods on credit, you might also want to look at the credit worthiness of the customers. So as part of your internal controls, you might want to have a credit department which looks into the credit worthiness of potential customers before you ship out goods on credit. So you are looking at the credit criteria for your customers. And then you want to have a robust collection policy. So collection policy is basically making sure you collect the payments from your receivables. Now, collection policy, make sure you got ethical and business-like collection policies. Don't send goons to collect your receivables. That won't be fair. That'll erode your brand value. So now we're looking at receivables management, where the focus here is to reduce the number of days in accounts receivable. But there might be times when you want to go for alternative strategies. Let's say you're going for seasonal dating. So what you do is you ask your customers to buy goods from you in the off season, in the non-peak season. In the peak season, everybody is buying your goods. But now you tell them, buy the goods in the off season. Don't pay me yet. Pay me when the season comes. Pay me later. So though that might increase the number of days in average accounts receivable, that would ensure round the year sales for you. So let's talk about an air conditioning company. Let's talk about Carrier. So they have, let's say, they're looking at the Indian markets where there's a lot of demand for air conditioners during summers, not a lot of demand in winters because the weather is pretty good. So they start seasonal dating. They ask their distributors to buy the ACs, the air conditioners, in winters, in the off season, and the distributors have an option to make the payments in the summers, in the season. So though this would increase the average credit period for Carrier, it ensures round the year sales for the company. So this is called seasonal dating. Now, as part of receivables management, companies might also want to go for accounts receivable financing. So you have accounts receivable on your balance sheet and you might want to finance it. So companies, so let's say you got accounts receivable here. So they go to the bank with a balance sheet and they say, look, we have so many accounts receivables here. And they pledge these receivables to get a loan. So that increases the amount of cash they have, accounts receivable financing. Now companies could also sell these accounts receivable. So they can take them off at the balance sheet, sell it to a factor who would pay them cash upfront. So that's basically converting these receivables into cash by selling them to a factor. So naturally, the factor is going to charge a fee for the service and he's going to charge some interest. Think about it. These accounts receivable, they were not due right today. They were due, let's say, in 30 days, 60 days, 90 days. So the factor, he's paying cash upfront. He is going to go to those receivables after 30 days or 60 or 90 days and collect the cash. So he's going to charge interest for that period. So the factor, he would charge a percentage fee and he would charge certain amount of interest. Now, the sale to a factor who goes out and collects could be with recourse or without recourse. With recourse means if there are any bad debts, if some of these customers, they default, the factor has recourse. He can come back to you and recover it from you. But if it's factoring without recourse, that means it's the factor's liability. Even if some of the customers, they default, the factor would bear the risk of bad debts. Naturally, if it's factoring without recourse, the factor would charge a higher percentage fee. If it's a factoring with recourse, when he can come back to you when there's a bad debt, he would charge a lower fee. Highlight there, seasonal dating. Alright, sell in off season, collect cash in season. Now you got key formula for accounts receivable turnover formula. Let's assume, put in numbers, net credit sales is $900,000. Alright, average accounts receivable, that's $150,000. So the accounts receivable turnover in this case is 6. Next formula, number of days in average receivables, we're looking at 360 divided by accounts receivable turnover. Right there, 360 divided by 6 gives us 60 days. Or we could do average accounts receivable by net credit sales per day. So the average accounts receivable is $150,000. So we had net credit sales of $900,000 in a year of 360 days. So the net credit sales per day is $2,500. And this again calculates to 60 days. Entities could also go for accounts receivable financing. So that's utilizing receivables to generate immediate cash. So they could have their receivables highlight pledged or highlight factored. So in pledging, a loan is obtained with the receivables offered as collateral for the loan. Now in case of factoring, the receivables, they are sold to a factor. So right there, factoring equals sale of accounts receivable to factor. And right within brackets, factor pays cash now but collects accounts receivables later when they are due. So right, cash paid by factor equals accounts receivable less fees. So we're looking at the factor's fees less interest. So we're looking at the interest delay in the collection of receivables by the factor, and minus any holdback by the factor. So the factor could have holdback for sales discounts, sales returns not accounted for. Now we could have factoring without recourse, and factor has no recourse if there are bad debts. Then with recourse, factor has recourse if there are bad debts. So now we look into inventory management. So here we have seen cash management, marketable securities management, receivables management. Time for managing inventory. We've already looked at the inventory turnover ratio. So here the question is, how many times does an entity turn over its inventory during the year? So it buys inventory, sells inventory, buys inventory, sells inventory, buys and sells. How many times does it do that during a year? So our formula for this, we know the denominator is going to be inventory. Guys, whenever it's a turnover ratio, remember you need to turn it over. So accounts receivable turnover ratio, denominator average accounts receivable. Inventory turnover ratio, denominator average inventory. Now, accounts receivable, that was related to credit sales. Inventory, that's related to COGS on the income statement, cost of goods sold. So that's the numerator here. So that's your formula for inventory turnover ratio. So let's say an entity has average inventory of $60,000 during the year. So that was beginning inventory plus ending inventory divided by 2, and COGS of $720,000. So that gives inventory turnover ratio of 12. So the entity was able to turn over its inventory 12 times during the year, buy and sell. So to understand this further, let's look at the number of days in average inventory. That is 360 divided by this inventory turnover ratio. So we are 360 divided by accounts receivable turnover. You're looking at 360 divided by inventory turnover. So if we do 360 divided by 12, that gives us 30 days. So every 30 days, the company was able to buy, sell. They did that 12 times during the year. Now, if you build up this formula further, you could have average inventory by COGS per day. So if you put COGS divided by average inventory and here mathematically work it around, you're going to get this. So what's average inventory? That's $60,000. What's COGS per day? Assuming a 360-day year, COGS per day would be $2,000. So that again calculates to 30 days. So this is basically the same number, two different formulas for calculating the number of days in average inventory. Now, when you're looking at inventory management, our goals are to, number one, maintain adequate inventory. We need to have enough stock with us. And number two, minimize inventory costs. So here we are looking at the inventory carrying cost. So higher the number of days in inventory, higher the inventory carrying cost. So you want to minimize this, minimize your inventory carrying cost. Now at the same time, you also want to look at your inventory ordering cost. So every time you order inventory to your vendors, how much does it cost you? You want to look at inventory receiving cost. Whenever you receive goods, how much does it cost you every time? And you also want to consider the cost of running out of inventory. Now, if you're too focused on reducing this, let's say instead of 30 days, you just want it to be 3 days. You're too focused on reducing this, you might run out of inventory and you might have high costs of running out of inventory. So those would include stoppage of work. Let's say you lose certain sales. You lose profits, you lose customers, because if you never have inventory, customers don't want to come to you. So all these are inventory costs that you want to consider when you're doing inventory management strategies. And there's a lot of decision making that happens here. Let's say we're looking at the production pattern for a product which has got seasonal demand, let's say air conditioners. Now the question here is, should you go for seasonal production or level production? So air conditioners, I said, you're going to have peak demand during summers, less demand during winters. So should you go for seasonal production where you produce more when there's more demand, produce less when there's less demand? The good thing is here is you're not going to have high inventory costs. Inventory costs would be minimized because only when there's demand are you producing it. When there's low demand, you're producing less. But the issue here is you might have higher cost of production. Because when you want to increase your production suddenly during the season, you might, let's say, have to pay high amount of overtime wages to your workers. Versus when you look at level production, so it says demand could be up and down, but the production, it would be level. Good news here is the production costs, they won't be too high because you'll have a level of production being maintained throughout the year. Bad news here is you will have high inventory costs. Because during the off season, where the demand is low, your production would be pretty high. So that's all decisions that you need to take when you're doing inventory management. Let's say if you're looking at inventory of commodities, let's say crude oil or silver, which have inflation, deflation, which keep moving up and down, you might prefer to have low levels of inventory, or if you have high levels, go for hedging so that you don't lose money on those commodities. Now, for inventory management, companies often go for MRP, or that's materials requirement planning. So they have a computerized system where finished goods production and inventory is managed based on demand forecasts. Now these days, companies, corporations, they have ERP, or enterprise resource planning. So this is an enterprise-wide, remember enterprise resource planning, so this is an enterprise-wide computerized system which connects the entire enterprise, connects all the functional areas. So let's say we're looking at purchase department, we're looking at production department, we're looking at marketing and sales department, and we're looking at distribution teams. All of them is connected via this enterprise resource planning. Make sure that there is efficient supply chain management. Now, when we're doing inventory management, there are a couple of key questions that we have. The first question is when to order the inventory. What's the reorder point? So the question here is when to order inventory. And we're looking at what's the reorder point. Now, when you order goods to your vendors, it takes some time for them to process the order, and then it takes some transportation time before the goods actually reach you. Now, the time that it takes from your placing of the order to receipt of the goods, that's called the lead time. And let us say the average lead time is 10 days. So your reorder point would be average demand per day into average lead time. So let us say you need 25 units every day and your average lead time is 10 days. So you would want to place an order with your vendor whenever your stock is 250 units, because it's going to take 10 days for the goods to reach you after you place an order. But then guys, wait a minute. There could be times when there is a delay. There could be a delay from the vendor's side. There could be a transportation delay. And you have seen that the maximum lead time from the time you place an order to the time you receive the goods is 15 days. Now, average is 10 days. It could even be less than 10 days, but the maximum is 15 days. Now, this difference here, 10 to 15 days, this could be disastrous at times. So, you want to maintain a safety stock. So what you would say is reorder point will not just be 250 units. You want to keep a safety stock to adjust, to manage if there is a delay to the extent of the maximum lead time. So this one is 5 days here. So you would say I want to maintain a safety stock for those 25 units for 5 days also. So your reorder point would basically be 250 units here plus 125 units, the safety stock, to make sure that if the lead time is more than the average lead time, you don't run out of inventory. So this calculates to 375 units. That's your reorder point. The question here was, when should you order inventory to your vendors? Now the next question, how much to order? Should you place orders with your vendors every other day, every week, or would you order them every month, every quarter? So basically you try to understand what's cheaper. So let's say when we're looking at bulky or expensive raw materials, you might want to procure them in small lots. You might place orders every week or even every day. But if it's, let's say, cheap products which don't take a lot of space, you might decide it's cheaper to place orders once in a month or once in 3 months. So basically what you're looking at is calculating the economic order quantity. So this question was when. Now the next question is how much. So here you're looking at calculating the economic order quantity, EOQ. Now the formula for this is 2 into A, or rather 2AP divided by S. Now where A stands for annual demand, P stands for cost per purchase order, and S stands for cost of carrying 1 unit for 1 year. So guys, as you can understand, if you look at this formula very closely, we can see that if the cost of carrying the inventory, so what are the costs of carrying the inventory? So here you're looking at storage cost, you're looking at interest cost because you're going to pay your vendors even though you're carrying your inventory. You're looking at spoilage, you're looking at insurance cost when you're storing the inventory, you're looking at obsolescence cost. So there's a lot of cost of carrying the inventory. So if you think the cost of carrying the inventory is pretty high, you would want to have a lower economic order quantity. So you might want to order in smaller lots. And similarly, if I would say your cost of purchase is low, that means it's okay, you have an efficient purchase department and your cost of placing per purchase order isn't too high, it's pretty low. Even then, it would be good to have a lower economic order quantity. Versus, let's say, if your cost to purchase is very high, or your cost of carrying inventory is very low, either of the two cases, you would want to have a high economic order quantity. So economic order quantity is increasing with the increase in cost per purchase order. But as your cost of carrying the inventory increases, economic order quantity decreases. So if cost of carrying inventory is low, in that case you're happy with a higher economic order quantity. So let's look at numbers that you have on the example on your book. So it says if the average usage of the product is 100 units, it costs $2 to process each order and $4 to store each unit of inventory for a year. So we're looking at annual usage 100 units. So let's do square root of 2 into 100 units into cost per purchase order, that's $2, divided by cost of storing 1 unit of inventory for 1 year. So that's $4. So that's 200 into 2, 400. 400 divided by 4 gives you 100. Square root is 10. So you're looking at 10 units as your economic order quantity here. So what we are saying is the annual demand is 100 units and you should place orders 10 units at a time. So ideally you would have 10 purchase orders being issued for the entire year. 100 units annual demand and economic order quantity 10 units. So 10 units at a time, 10 times you need to order your vendors if you want to have an effective, if you want to have an efficient inventory management system. So basically what we are saying is if you're looking at big items, let's say, if I'm looking at an air conditioner manufacturer and I'm looking at compressors or the body of the air conditioner, then it's expensive, it's bulky. The cost of carrying it here is pretty high. I want to have a low economic order quantity. I'll order in small consignments, smaller lots. But if I'm looking at small parts, let's say certain nuts and bolts which go into manufacturing the air conditioner, that's pretty cheap stuff. So cost of carrying it is pretty low. Happy having a higher economic order quantity, the green pen here. Now, the modern system of inventory management, let's say we're looking at car manufacturers, is just-in-time inventory. Now, basically, that's a system where the manufacturers, they choose to have zero inventory, negligible inventory. So let us say we're looking at General Motors and they are manufacturing 10 cars tomorrow morning at 9 o'clock. So purchase orders are issued to all the vendors. So we're talking about vendors for the car bodies, we're talking about vendors for the engines, we're talking about vendors for the tires, for the seats, for the glasses, for the windshields, everything. All the vendors are asked to deliver 10 numbers at 9 a.m. in the morning. So all the raw materials come in at 9 a.m. and the production start. So raw materials come just in time for the production to start. Then let's say at 10 a.m. they have another 5 cars to be going up on the assembly line. So all the vendors now supply 5 units at 10 a.m. Let's say another 5 cars at 11 a.m. So all the vendors again supply 5 units at 11 a.m. So that is basically just-in-time inventory. Basically what you can say is, when we're looking at just-in-time inventory, the economic order quantity is very low. So at 9 a.m. we asked for 10 units, 10 engines. At 10 a.m. 5 engines. At 11 a.m. another 5 engines. Very low economic order quantity. Because what we are saying here is the cost of purchase orders, that's very low here. Those vendors, they are very closely knit to us. It's no issue we raising multiple purchase orders. But the cost of carrying the inventory is very high. The cost of carrying is storage space. It's basically interest cost in inventory, obsolescence, the inefficiencies due to storage. So in just-in-time inventory, multiple number of purchase orders are placed. Why? Because purchase cost is very low per purchase order. So high number of purchase orders, because the purchase cost is pretty low per order. But inventory, that's nil or negligible, because the cost of carrying inventory is assumed to be very high. So this one is just-in-time inventory, where raw materials come just in time for manufacturing to happen. Circle goals. And the major goals of inventory management are: highlight maintain adequate inventory levels, and highlight minimize inventory costs, which include carrying costs of inventory, ordering costs, receiving costs, and costs of running out of inventory. Next, highlight materials requirements planning, MRP. Highlight enterprise resource planning, ERP. Looking at the key inventory formula, inventory turnover equals COGS divided by average inventory. So if COGS is equal to $720,000 and average inventory is $60,000, inventory turnover ratio is equal to 12. Then you have number of days in average inventory. So that's 360 divided by inventory turnover equals 360 divided by 12. That's 30 days. Now you could also calculate it as average inventory divided by COGS per day. So we got the average inventory number of $60,000. Now if COGS for the year is $720,000, COGS per day is $2,000. So that again gives us number of days in inventory equals 30 days. Then we have a calculation for reorder point. So right there, when to order. And highlight reorder point equals average daily demand multiplied by average lead time plus safety stock. Next, write how much to order and highlight economic order quantity, EOQ. Also highlight the formula there. So EOQ equals square root of, highlight 2AP divided by S, where A is the annual demand in units, P is cost to place an order, and S is cost of carrying 1 unit of inventory for 1 year. So for P there, write purchase. For S, write store. And highlight includes storage cost, interest cost, spoilage, insurance cost and obsolescence cost. Highlight inventory financing, that's borrowing funds by using inventory as collateral. On the next bullet, we're talking about highlight just-in-time philosophy. And right there, frequent orders and no inventory. Also right, P is low, so the cost of placing a purchase order, that's very low. And S is high, the carrying cost of inventory here is very high. And that is why EOQ or the economic order quantity is low. So in just-in-time philosophy, we issue frequent orders and carry negligible inventory. Also underline, just-in-time systems can break down if suppliers do not provide timely delivery or they supply non-conforming goods. So just-in-time is possible only when there is a good, strong relationship with a few reliable suppliers. Now under just-in-time, we might want to use highlight backflush costing approach, which is also called delayed or endpoint costing. Now in this approach, all manufacturing costs are directly charged to cost of goods sold since there is little or no inventory at any point in time. Now at the end of the accounting period, the company determines if there actually are any inventories. And when inventories exist on a reporting date, costs are allocated from cost of goods sold into the appropriate inventory accounts such as finished goods using standard costs. Let's look at the journal entries that happen here. So write purchase. On the debit, write inventory. On the credit, write accounts payable. Now scratch off inventory and write COGS. So instead of debiting inventory on purchase, we directly debit COGS. And right there, assume inventory equals nil. Then write end of year. We determine if there actually are any inventories at hand. And if yes, we'll pass the journal entry, write inventory debit and COGS credit. Right there, for any inventory in hand at year end.